Good afternoon. My name is Mike Manning, the Managing Partner of NEPC, and I want to welcome you to our 2018 Market Outlook, where we'll talk about our investment overview and opportunities we see in the marketplace. We really try and deliver our viewpoints in multiple ways to our clients. Obviously, this is the first step. Over the next few days, we'll be posting our market thoughts, which captures what happened in the fourth quarter of last year, and also our annual asset allocation letter, which takes the opportunities and themes we're going to discuss today and fleshes them out a little bit. So please keep an eye out for those. And then obviously, when each of you meets with your consultants over the next quarter or 6 months, we'll bring these asset allocation themes to you and how they specifically rate to your goals and objectives. So thank you for taking the time with us today. I am joined by Phil Nelson, the Partner and Director of Asset Allocation, and Andrew Koop, who is relatively new to NEPC, but a senior consultant with a lot of background in insurance. The insurance market is something that we've done for a long time. We're excited to have Andrew as part of it, and really leverages off our strengths in building customized portfolios and tax-aware research. So he'll give a little bit of an overview there, understanding that not all plan types have insurance portfolios, but there is some carryover, and it's interesting to see a different client segment through a little bit more detailed lens. So the agenda for today is a quick look back on 2017, a very short update on NEPC. Then Phil will talk about the market themes and current opportunities we see. As I mentioned, Andrew will talk about the insurance market, and then we'll come for questions at the end of the presentation in about 35 minutes or so. If you can, as questions pop in your mind during the presentation, if you look on the right side on the panel of the webinar, you'll see an area that says questions. If you type those in, I will collect those, and then at the end of the presentation, we'll try and ask as many of those as I can in the time we have allotted. So I'm going to shift now and talk briefly about 2017. Most of you already know 2017 was an excellent year. So what we show here is 2016 in the light green, 2017 in the dark green. The thing that stands out for both years is that every asset class was positive during this period of time. And you can see that for most asset classes, 2017 was a better year than 2016. Particularly the equity-related asset classes of large cap, international equity, and emerging markets, and even private equity over to the right. So it really was a great year for clients in terms of their overall plan return, in terms of the benefits from being globally diversified, and frankly, for many of you, for the impact from the individual manager. So we're seeing really strong returns for our clients during the year, which we think is fantastic. To put the last year in a little bit of perspective, we looked at U.S. stocks and the consecutive months of positive S&P 500 monthly returns. So how often does the S&P go on a run, if you will, of consecutive positive months? And what you can see from looking at this chart, so this goes all the way back to 1927, the longest streak was 15 months, and that was back in 1959. The cumulative return there was 50%. The current streak is 14 months. So we have not had a down month since October of 2016. And if things were to stop today, the U.S. S&P 500 would be positive again. So we would match that longest streak. You'll see the cumulative return over that time period, not quite as high as at 50%, but it's still been up 29% in the 50 months. The 14 months since this started. So it really has been a very strong, positive return in the U.S. stock market. The fact that we've had so many positive months in a row is evidenced by the decline in volatility that we've seen in a lot of the different markets, and that's something we think is certain to watch out for next year. As we think about our investment outlook, I thought back to what our message has been over the last 3 or 4 years, and I worry it's a little bit like crying wolf. And what I mean by that is the message has been low returns. So for the past 2 or 3 years, or maybe even longer, we've said don't expect the returns you've experienced since the global financial crisis. That clearly hasn't come true, when most plans will be up in double digits for last year. But as Phil will talk about later, we do see the outlook as being muted because of those really high returns and the valuations creeping ever higher as this positive market environment extends. The next page looks at data from Greenwich Associates. So Greenwich Associates goes out to institutional investors and tries to collect feedback on what is important to you, or what are the things that you're focused on in the marketplace. This is a subset of the answers that they received, but some of the ones that I thought were interesting. So if you look from left to right, you'll see on the left the rate of return and funding issues was a very big issue in 2016. We saw a lot of uptick. That's come down a little bit after last year as the plans have done so well. What's popped up this year, however, is asset allocation. And so I think, again, looking out, trying to find places where the assets, where you can allocate your assets to help get to the return that you need. A few other things that I thought were interesting. Market volatility is less in people's minds today than it was a few years ago. Again, not a surprise when we haven't had a negative S&P 500 month in the last 15, and the same holds true across the currency and the fixed income markets. Manager selection is more prevalent today in terms of a concern or area of focus. And I also thought it was sort of interesting, given the current political regime, that people were worried more about government regulation going into 2016, and these interviews are taken in the fall of each year, whereas it's less of a concern as we hit 2017. So just a little bit of window into what other investors are seeing as primary areas of focus and concern. One of the other interesting data points that we get from Greenwich is the asset allocation by different client types. And so Greenwich really can only look at, or really focuses on these institutional types, and obviously where we work with families and other taxable pools like insurance, we have a broader perspective, but this is really an independent look, and I think validates what we see in the marketplace today. So looking again from left to right, I've organized this by whoever has the most fixed income exposure to the least. And so not surprisingly, corporates and healthcare have the highest fixed income exposure. Corporates more because you're seeing liability-driven investing, healthcare more because of the operating assets and the need for current yield in parts of their portfolio. As you look further to the right, you'll see the increase in alternatives, particularly in the endowment foundation space and in the public space. Across all of these market segments, we've seen the ratio of alternatives picking up. At the top, other investment includes things like multi-asset or GTAA portfolios or cash or commodities or things like that. So anyway, it just gives you a window again into what other types of clients are doing. So if you're in one of the segments, understanding what the drivers are of different portfolios for people with different needs and objectives. If you went back and looked at this, 25 or 30 years ago, most plans would be closer to 60-40. And what we've seen at NEPC is that the plans are starting to build their asset allocations on a much more customized way, more thoughtful to their own particular goals and objectives and constraints that they have to operate in. So this is not a surprise to us to see this trend in the marketplace as a whole, and we've certainly seen it within the client base here at NEPC. So I thought I'd just give you a very quick update on the firm. The big picture is the same in terms of, our goal is to be the consultant of choice. So for people who need an investment advisor or people who want to work in the investment consulting industry, we want to be top of everybody's mind. The core tenets of who we are in terms of being independent, employee-owned, 100% focused on our asset owner clients are consistent. We work across a lot of different client groups, as I mentioned before. And with 358 clients, we think we have the breadth to understand a lot of different needs and goals and objectives and bring that to your particular plan. So while we're a big firm, I think our focus is on trying to feel small but be big. And let me talk about what I mean there. In terms of feeling small, this is how we want you to experience working with NEPC. So we're flexible, we're customized, we're working with you to understand your particular situation in a true partnership mindset. We have, while we're a big firm, we have dedicated segments, and their job is to understand the challenges that are facing you in your particular market segment and anticipate your needs and help you address those with your portfolio. And then even to identify niche managers and investment ideas. We have a 50-person research team, or 55 people almost, whose job it is to focus on getting the best investment ideas, and they spend a lot of that time trying to find newer and niche investment managers that we think can help you meet your goals. In terms of being big, we want to have deep resources at your disposal. So to the extent that you have specific questions or want us to canvass a wide array of managers, we can do that because of our deep research team and the expertise we have across the whole firm. We try and use that size to benefit you in terms of getting access to managers and getting the best fee terms that we can. So we spend a lot of time working with managers to benefit you and your investment programs. And then we want to share the learnings and insights across all of those client segments. So Andrew will talk about insurance today. There are things specific to insurance portfolios that we can learn and then carry over into other market segments, just like there is that cross-pollination of ideas from any one market segment to the other. So instead of just being focused on one particular client type, we think there's a real benefit to understanding a greater array of problems and challenges that investors are facing and customizing portfolios to meet their needs. So anyway, the main story about NEPC is more of the same, continue to be a strong and healthy firm and working to help you meet your needs. We're going to switch now to Phil, who's the Director of Asset Allocation. He's going to talk about the market themes and opportunities that we see heading into 2018.
Great. Thanks, Mike. So we're going to briefly walk through our market outlook for 2018. You really can distill it down into kind of these three major bullets. One is our outlook for equities outside the U.S. has improved. We're seeing positive growth metrics and a resurgence in global economies outside the U.S. that we think will really flow through into higher levels of earnings for companies outside the U.S. Second is somewhat of a conflict with our message of kind of a pro-risk message on one side with non-U.S. equities, but thinking about kind of market stability, thinking about look to rebalance your quote-unquote safe haven fixed income exposures. This might include core bonds, TIPS, municipal bonds, back to targets that maybe previously existed 3, 4, 5 years ago. I mean, Mike clearly walked through. We're at kind of record runs for U.S. equities, and that's not going to last forever. And last, when we kind of think about this and tie it together, it's overly simplistic, but it's a tried and true concept. Is simply just reducing exposures to assets that have done well and exceeded expectations, and adding to exposures that have underperformed or haven't met expectations over, let's say, the last 3-5 years. And looking at that, you can kind of see here where we're shading some of our asset class views. This is on a Sharpe ratio basis, looking at the 5-year Sharpe ratio of these major asset classes relative to their history. So when we think about the S&P 500, we're looking at the 5-year Sharpe ratios at the kind of 90th percentile relative to a 90-year history. Something like high yield bonds, again, exceeding expectations. And then when we look to U.S. TIPS, something that we have a favorable view on, near the bottom range of historical outcomes, shifting some exposures of the portfolio to there. We'll hit on some of these ideas in what we call our key market themes and current opportunities. And real quick, just touch on our key market themes we view as the kind of broad-based market environment from a macroeconomic perspective that explains or informs kind of global asset classes. So 2017 was a great year for risk assets, and we look at the themes that we had last year, they all kind of trended very positively. So the U.S. economy did well. The Federal Reserve moved in kind of a slow, measured fashion. Everything related to China in many ways was a smooth transition, moving from kind of an industrial-based to a more service-based economy. And then we think about some of the risks associated, which we label globalization backlash, but includes everything from trade policy and a populism rising in Europe and the US. And a lot of the outcomes that were feared really trended in a positive fashion when you think of French elections or whatever it may be. So equities and risk assets really did well. And so the one point that we would caution going into 2018, any disruption in any one of these themes can really flow through and have a material impact on asset class volatility, which is something we just haven't seen over the last several years. The bottom half of this page is our current opportunities, and this is really taking the macroeconomic backdrop of our themes and filtering it through kind of a fundamental lens to say, here's where marginal dollar shading a portfolio we think makes sense. And we'll go through some of these in a bit. So thinking back to the U.S., when we think about the U.S. economic cycle, this looks back in major cycles going back to kind of post-World War II, the same exact slide we had last year at this point for this call. And, you can see that, there's a decent history of long economic cycles, going back the last 70 some odd years. And this most recent cycle, while close in duration, is still very much kind of under-delivering historical growth expectations. A lot of reasons for that: demographics, low inflation, low investment rates in some cases. But what we're seeing is the profile of kind of a slow and steady U.S. economy from a growth rate perspective allows it to maybe continue for the next several years and kind of extend this cycle, so we're not really eating into, let's say, the economic capacity that would be common for kind of the tail end of a cycle. So when we look to, jobs, and employment, wage gains, inflation, we're really not seeing the kind of excesses that one would see in kind of a late cycle profile. Thinking more globally, so, a positive, growing U.S. economy feeds into this, but it's not the only story. When we think about kind of global growth over 2017, kind of a unique profile where we saw essentially the largest 45 countries in the world, where we saw 35 of them accelerate their growth rates. 15 of them slowed from already positive rates, but remained positive. And this is very much a contrast to, the last 8 years of an economic profile that we've seen. So the kind of synchronization of these growth rates, we think are really positive for equities outside the U.S., flowing through from revenues, corporate earnings, kind of sentiment that we think benefits assets outside the U.S., and could have a benefit within the U.S. as well. But at the same time, when we think about valuations, which we'll talk a little bit later, we'll skew there.
Yeah, so maybe just a question here, Phil, real quick. If you look at the chart and you see the period from 2004 to 2007, once that global synchronization got started, it kept going for a while. I think that's one of the themes that you talked about. Maybe just touch on that. Yeah,
and that feeds into this view of the resurgence, quote unquote, of these growth trends don't just stop and start quickly. They tend to persist for several more years, and there's a natural cycle to them. So this last year was the big improvement of kind of repricing global growth rates. And then over the next several years, one would expect that these rates will slowly decline, but still remain positive and incremental boost for, we think, risk assets broadly. Turning back to the U.S. and kind of the impact of central banks. We painted, so far a very positive story when it comes to global economic environment. But there's other trends, other themes that, could be poised for disruption to disrupt the positive signs that we're seeing. Federal Reserve policy is one. We've talked for several years about kind of gradual changes in Federal Reserve policy really being a boost to U.S. financial conditions. We've seen that, and really over the next couple of years, the path of Federal Reserve policy is going to be critical. And should it be a slow and steady path, we think that remains kind of a positive for markets. But should we see a repricing where Fed rate hikes accelerate, whether it's because of inflation or other reasons, that could bode ill for both the global and U.S. economy. And you see that here, where previous times, U.S. economy falls into recession for kind of one or two reasons. One is a rapid tightening in Federal Reserve policy. Monetary policy tightening leads to lower economic activity and/or credit crisis. We don't necessarily see a credit crisis on the horizon, but we have to be cognizant of the risks of recession conditions being the result of rapid Fed rate hikes. So this is something that we think about that provides somewhat of a bout of caution. Then thinking about China, again, this is kind of a repeat from last year. Global economic conditions look really good going in 2018. Growth rates are higher across developed markets, across the board, especially in Europe. But at the end of the day, China's the critical component. China represents half of kind of incremental GDP growth, and so it gets back to the old adage that was used for the U.S. If the U.S. economy gets a cold, the world gets a flu. Same can be applied to China today. If China has some sort of disruption in their economy, or their massive transition of moving workers from kind of rural counties into the cities, moving from an industrial production-based economy to a more service consumption based one, any disruption in that will likely flows through to global volatility amongst asset classes. And we think for the last two kind of major disruptions to the markets, where S&P was down close to 5 to 10%, it really emanated from China around concerns around currencies and their reserve levels. And last is kind of another piece that just makes us think of everything worked really well last year, but that's not necessarily in the cards for the coming years. And trade policy out of the U.S. is one of those risks, and we think it's a real kind of tail risk for global markets, and that a major disruption in kind of the orthodoxy of U.S. trade policy likely flows through not just emerging markets, not just developed markets, but also likely the U.S. if you see disruptions in kind of the integrated inventory supply chains that we have today. And these aren't, this is not meant to include small changes in tariffs on solar panels or whatever it would be, but these are kind of large dramatic shifts that are unlikely, but definitely something that we should be aware of, whether it's completely removing ourselves from NAFTA or changing our trade relationships with Asia. So that's the themes that inform kind of our macroeconomic outlook. I said before, these flow through into our kind of current opportunities, which we apply a bit of a fundamental lens on in terms of kind of views for clients. We'll touch on a couple of those. We're not going to hit on all of them. The first is with the U.S. and just encouraging folks to trim their gains in U.S. equities. Bringing them back to targets that maybe they were 4 or 5 years ago, or even looking to possibly underweight a bit to reallocate assets to international EAFE and emerging markets. And really, the story is not to say we know when the U.S. equities are going to turn, but looking at the profile. Historically speaking, when we look at the return profile for U.S. equities over the last 25 years, majority of the return comes from real earnings growth. The remainder comes from some component of essentially inflation and dividends. And what we experienced in the last 6 years is really, bounty of returns for U.S. equities, but the overwhelming majority has come from valuation expansion. So that's PEs expanding in a low interest rate, low inflationary environment, but that's not a sustainable path for the next 6 years. So we see that normalizing over time. Thinking about non-U.S. equities, when we look at EAFE markets, which we generically label Europe and Japan, with some of the changes in growth rates that we're seeing around the world, we think companies' equities in these markets are really likely to benefit. And since the financial crisis in 2008, we've seen U.S. equities from an earnings perspective, really touch new heights. When we look to EM, quick recovery post 2008, 2009, a bit of a kind of earnings industrial recession, 2015, 2016, real recovery there that we still think has room to run. And then looking at EAFE markets, earnings on a trailing basis for these companies are still below their peaks that we saw pre-financial crisis. And the opportunity for these markets to normalize, become, reach profitability levels that maybe we saw 10, 15 years ago, offers a materially higher return for these equity markets. And even assuming these markets get back to half of where they were in 2007, that's still a really positive return outlook for these equity markets. And lastly, on the equity side, a bit of still more kind of a secular view, but still a positive one. When we think about emerging markets, and we still see incremental growth relative to developed markets, which as that growth differential between EM and developed expands, that's typically a positive backdrop and foundation for European equities, or excuse me, emerging market equities. And when we look at emerging equities, we still see valuation levels are somewhat compelling, and especially so when you compare them to kind of the U.S. and developed markets. On the kind of more cautious side, thinking about credit exposure, looking at some of the major credit asset classes here, high yield and dollar-denominated EMD debt. We see credit spreads, approaching kind of more of a one standard deviation level of away from the mean of on an expense basis. So we think credit spreads are on the expensive side these days, and for many investors, we think the risk that they offer doesn't really compensate investors for the possible returns that we could be seeing over the next couple of years. So thinking about that, encouraging folks to reduce credit exposure, reallocate into the remainder of the portfolio. Maybe it's partially equities, partially safe haven exposures such as TIPS, core bonds, munis. And with that, broadly kind of covered the views perspective. It's also informing that is our capital market outlook. This is a summary of the 50-plus asset classes that we develop an outlook for, and looks at the major asset classes in a 5 to 7 year return view. So just thinking about how does this compare relative to last year, cash is one that slightly higher, but makes sense because we think the Fed's going to slowly and gradually be raising rates over the next 5 to 7 years. But essentially, looks at cash at a 2% level becomes more of a normalized assumption, which is still much farther below from the history we've seen over the last 70 years. Thinking about U.S. equities, our assumptions down 50 basis points. This is one where entirely driven by valuations. And embedded in this, we're not assuming valuations return to long-term medians. We're not assuming profit margins assumed to revert to long-term averages. So there's a bit of judgment applied here that this number could have been much lower, but thinking in the context of low inflation, low interest rates, feel that some benefit of the doubt should be given to U.S. equities. International equities up 25 basis points, really reflecting the higher return outlook. EM down, emerging market equities down 50. I spoke a bit about high yield bonds down 100 basis points relative last year, and that's really reflective of just pure valuations. Spreads have come in. We assume over time spreads will start to normalize, and that has a price impact on the future returns for high yield bonds over time. So with that, thinking about that as the return backdrop, Mike started, the discussion, talking about, we've been talking about, the risks of low returns coming to markets. And then the question is when. And when we look at this graph here, we can see, the green line here is kind of the plotting of the 10-year return history of a basic 60-40 portfolio going back to the late 20s. So, U.S. stocks, essentially core bonds in a 60-40 framework, overlaid with a basic return model similar to kind of a Shiller Cape, and also a yield-based model for the fixed income sector. So fairly strong relationship, fairly strong correlation between 10-year actual returns and implied returns over 10 years from this type of framework. And today, looking forward, currently forecasting about 1.7% return coming out of US-based assets. And we think about what have we achieved over the last 5, 6, 7, 8, 10 years. So the view essentially comes, we don't think the last 10 years are a necessarily path for success for the next 10 years. So thinking about doing something different, looking in other areas of the portfolio.
Yeah, so maybe just before we leave that chart, if you want to go back very quickly, one of the things that's going to change for most of you as you look at your performance reports is as we get later into the year, the 10-year number is going to start to look really good because the 10-year number today includes what happened in 2008. And as we work our way through the year into early 2009, that 10-year look back is going to be closer to what you see, that sort of blue spike there from the 2007, 2008 period over on the right part of the chart. Our concern is really what's going to look like 10 years hence, looking back. So maybe Phil, just touch quickly on the outlook, and then we can turn it over to Andrew.
Yeah, and just to summarize our views quickly. On the inflation side, we think marginally shift higher in the coming years, but that still feeds into kind of a slow and steady move from the Fed, which we believe will allow financial conditions to remain fairly loose in the U.S., which supports a steady economic gains, we think, in many ways for the next couple of years. And then globally, the resurgence we're seeing in growth rates really supports that outlook for non-U.S. equities. But at the same time, we know asset returns from the public markets really will be less supportive for investors to meet their long-term objectives, let's say over the next 10 plus years. So thinking about private markets, thinking about incorporating that into your long-term asset allocation, at the same time being patient and prudent about it, because I think many of us have heard the dollars and fundraising that's occurred in the private market side. So with that, turn it over to Andrew, who's going to discuss what we're seeing in the insurance market, and then we'll take questions from there.
Thanks very much, Phil. This is an absolutely perfect time for me to be talking about insurance because this week we've seen the 10-year bust through 2.7, and insurers everywhere are celebrating because we've not seen this in the last 3 years. What a great time to be in insurance. The reality is that insurers are facing the same economic backdrop that every insurer is, but there are many more subtleties to insurance investing. I think Mike presented in an earlier slide how most of our investors have a 40-45% max to fixed income. Well, insurers are more along the 80% line. It is very, very strongly the portfolios are very strongly focused on fixed income, and they have been like that since time began. When you look at the restrictions placed on insurers, whether that be through accounting regulations, whether it be through regulations put on them by rating agencies, or just regulators themselves, insurers have always maintained portfolios that have been heavily fixed income orientated. And you can see from the slide that we're looking at here, there's been huge changes in those allocations over the past 5 years. No, clearly not. With the headline allocations have moved at most 1% or 2% from fixed income to return-seeking assets. It's been a very, very stable time from a headline perspective. Insurers do not move fast, but it is a very large market, and you would not expect them to do anything quickly. Anecdotally, we do expect to see some changes in the coming year. There have been flows into private markets. There have been flows into lower quality credit strategies. We think it will show up in the 2017 numbers, and that will be released in the middle of the year. At NEPC, we've had a tremendous 12 months within the insurance space. It's really been an evolutionary year for us. The insurance investment consulting practice has had marquee wins across P&C, life, and workers' compensation portfolios. And the reason for that is our understanding of the insurance market. We're not just looking at the headline that you can see on this slide. When you dig into some of the numbers, this really highlights what I was talking about, is all of the industries have added risk in the safe portfolios. The fixed income piece has allocated to high yield and to private placements. Across P&C, health and life, we have seen increases in risk, and those risks have mainly been through credit and illiquidity risk. So what I would like to do now, having sort of set the context of what's happened in the past, is talk about the themes and opportunities going forward. And we've seen a version of this slide previously, but we'd like to add the insurance lens onto this. You talk about the themes that will impact investors in the insurance space going forward, and you start talking about the tax uncertainty. Insurers, specifically in P&C space, are heavy investors in the municipal market. This is a market with tax reform that could see significant volatility. And it's not just limited to the muni market either. There are proposals out there to the NEIC to shake up the capital charge on other credit instruments. This could impact the attractiveness of credit for insurers, and not necessarily just forcing it into higher quality either. One of the themes that we're seeing across the industry is investment managers are lobbying for look-through treatment on pooled vehicles. Pooled vehicles have been very challenging for insurers to invest in historically, and managers are looking to change that perspective. The capital charges make them less onerous and make them more attractive to insurance companies. And then the final theme that we can't avoid and is seen by insurance investors across the media is the proliferation of ETFs and the continued active passive discussion. We think that will dominate the headlines again in 2018, and we expect to spend a lot of time talking with our clients about that. So how do we put that into the current opportunities framework? Our strategy group comes up with the opportunities, and I think as to insurance investors, these all make sense. Trimming U.S. equity gains, overweighting non-U.S., and those apply to all investors. Adding tips to core bonds, maybe something a little bit more niche to insurers, but again, the protection from rising rates is certainly there. The three at the bottom: emerging market, local debt, macro hedge funds, and long volatility exposure. These can be much more challenging for insurance investors to look at. Our job as insurance consultants is to see how these opportunities can be implemented for constrained investors. So what are the projects and the things that NEPC are working on going forward in the insurance space? First of all, we're looking to pinpoint diversifying investment strategies that can easily be adapted to suit capital-constrained investors. That's taking the best ideas, taking the ideas that research develops, and using an insurance lens to make them appropriate for investors that have capital constraints. We're always looking to identify income-generating opportunities that negate a J-curve and can be attractive to insurers with near-term liabilities but require an increased return level. What we'd really like to do is determine a quantitative and qualitative methodology that can acknowledge value from specialist services that investment managers produce. It's the job of research at the moment to focus on, can the manager add returns? But that does not mean that value-added services cannot be beneficial to investors. We would like to develop a methodology to see if we can fully understand that. And finally, we want to develop a financial statement-based asset allocation model. We're looking to enhance the enterprise risk assessment methodology for insurance entities.
And that builds off our our enterprise model that we have in place for a lot of our healthcare clients and a lot of our corporate clients and even endowments and foundations, sort of a total enterprise approach. Thank you, Andrew. Maybe we'll switch now to questions. So I appreciate the folks who've already sent questions in. If you have an additional one, please type it in and we'll see if we can get to it. Maybe Phil, I'll start with you on the first one. How important do you think the low savings rate is in the economic perspective and our outlook?
Yeah, from the outlook perspective, it helps explain to some degree some of our views on the U.S. and the Fed. In some ways, you can look at the low savings rate in the U.S., which essentially amongst consumers, which declined more in 2017, as a sign of really the health of the economy and consumers being more willing to spend, draw down on savings, and we tap the credit card some more for bigger purchases. So it speaks to the sentiment of kind of positive economic gains. But at the same time, that's not a sustainable path going forward. So without material wage gains supporting higher levels of spending, that spending should decline over time, and kind of flows back into a more normalized level of economic growth, which we saw in one of the previous charts, which shows this economic cycle has much lower growth than we've seen in previous versions, and really speaks to the lack of wage gains allowing, a much larger spend rate from consumers.
Great. So, I think it might help actually to go back into the presentation for the next two slides, or next two questions. So if I can get you to go back to our asset allocation assumptions, and maybe I'll take this question. There we go. Sorry, right here. Thanks, Phil. The question related to emerging markets and international equities, and I'll paraphrase it. Let's just look at the top three equity lines there. You've got large cap equities, which were up, say, 22 last year. They're going down by 50 basis points. We've got international equities. They were up 24, 25. They're actually going up, and emerging was up 37 last year, and they're going down 50. And so the question, is effectively, why is international going up at the expense of large cap and emerging? And I really got to focus on the second part there. So thanks for the question. The international equities, I think our viewpoint here is one that global synchronized growth that Phil talked about will be helpful in terms of driving company growth in the international markets or international developed markets. So Europe, for example, or Japan are the biggest weights in those indices. And as they come out of what has been, a very prolonged, if not recession, a certainly slow growth period, the synchronized growth, both in their home countries, but also in emerging markets in the U.S., we think can help drive their returns higher. They also are coming from a place of the valuation is not nearly as high as where the U.S. is on a historic basis. And then finally, while emerging markets did perform a lot better last year, I think the spread we had between emerging markets and the other asset classes was very wide. You'll still see that the return of 9 for emerging markets versus the return of 7.5 for international equities. There's still a big spread there, but I think we felt that last year we've already priced in some of that growth into emerging markets, saw a really strong return, but the valuations we think and the future growth story still warrant a higher return assumption for emerging market equities. Maybe, Phil, just to go back to the Fed chart, if you can, give us a second when we get here so we can have a tough time going which way to go there, but there you go, that one. Go back to. Okay, so the question here is a long one, but on the Fed fund rate chart, why not interpret the chart that as the Fed decreases rates after recessions, the Fed is decreasing the rate after recession occurs, as opposed to the causation of increasing the rate creates the recession. So, you talked about it as the rising rates create the recession, and the question was, why not look at it the other way, that the Fed's reacting to what's happening?
Yeah, and really it is both. There's a cause and effect both entering the recession, and there's a cause and effect kind of pulling out or growing out of the recession. So you think of the typical path where inflation, increases in an economy, economy starts to overheat. Fed, central bank should be stepping in to lower economic activity. Often through history they've done that maybe in a too aggressive a fashion, which crimps down on economic growth, leads to a recession, and then you get the counter cycle of central bank reducing rates to help feed that economic activity to grow back again. And I think one of the things that we think about, especially the next 2, 3, 4, 5 years, is how much room does the Fed have to reduce rates should we enter a recession, considering where we are in a relatively low rate world.
So I think one of the things that's different this time as well is that if you look at the chart there on the right, I think one of the tools the Fed has used that they had not really in the past is they've done a very good job of communicating and signaling what it is that's coming down the path. So Phil mentioned they were maybe a little bit more aggressive in prior recessions. They weren't just more aggressive, they were more opaque. And so where today I think they've done a pretty good job of trying to get their perspective out in the marketplace so it works its way through as opposed to a shock to the system. So we're going to have one more question, but before I get there, I just do want to highlight this. We have our 23rd Annual Investment Conference in May here in Boston. That's a Monday and Tuesday in the middle of May, May 14th and 15th. We'll have more information to save the date. You can find information on our website. We'd love to see you there. We'll obviously get into the things we talked about today in a lot more detail. It's always a great time to spend with fellow investors and some really great outside speakers that we're going to have for you then. But let me get to the last question before we wrap up, and Phil, maybe just a quick answer because we're sort of at time. But what's our view on the U.S. dollar, and how does that make its way into the portfolio?
Yeah, so the view on the U.S. dollar at this point is we're close to fair value. We have a different stance than some where we have a more strategic view on currencies where the starting point is roughly a 50% hedge on developed market currency exposures, because we view for the most part currencies outside the U.S. and the developed world, whether it's yen, sterling, euro, offer a decent level of risk but minimal return. And so, thinking that in line, our bias is to hedge the USD. And where we are from a valuation perspective is relatively normal, so we are sticking to that hedged view, so to speak.
But still positive from an emerging market standpoint, I think.
Yeah, so EM relative to the U.S. dollar, we have very much a positive view on emerging market currencies, as opposed to we think developed market currencies are likely a source of volatility, thinking about low rate levels maybe rising, and a lot of the kind of globalization backlash concerns that we've seen in Europe and the U.S.
Yeah, and despite that, sort of like the other markets, a real low level of volatility there, at least over the past year. So on that note, I think we're going to wrap up. I want to say thanks again for taking the time to spend with us today. We hope you found it helpful. Please continue to look at our NEPC.com, the website. The Insights section is where we share all of our research views, both broad asset allocation themes, but also specific topical research pieces that we do. We look forward to working with you throughout 2018 to help navigate the markets. Take care, and I hope everyone has a successful 2018.